Welcome, everyone, and thank you so much for joining us for this important conversation. To make sure that everyone can hear, participant lines are muted. I just want to, before we get started, go through a handful of important talking points here. NCRC Code of Conduct applies to all NCRC events, including this session. You can see that at ncrc.org/code. We'll also put that in the chat in a minute. Speaking in the chat, please feel free to introduce yourself or ask questions of NCRC staff using the chat feature. And make sure, as you're listening in on this conversation, to tag at NCRC on Twitter and use #JustEconomy when posting about today's event. I'm going to go ahead and turn it over to NCRC's CEO, Jesse Van Tol, to introduce today's session.
Well, good afternoon, and thanks for joining us, everyone. We're glad you can join us for this really critical and timely conversation. For those of you new to NCRC, we're a coalition of community organizations around the country who take as their common vision creating a more just economy in America, with a specific goal of building wealth for people who have been cut out from opportunities to do so. And we focus on the policy and practice of housing, entrepreneurship, and banking services, with a mission of increasing historic and ongoing, a mission of addressing historic and ongoing inequities in those areas. So critical to the work that we do every day is the Community Reinvestment Act. It's a tool that we use to ensure that capital flows into low and moderate income communities and majority minority communities, which have historically been ignored and exploited and left out of our financial system. So today's conversation is all about some proposed changes to CRA that are on the docket. Probably all NCRC, probably everybody on this session is aware of those changes. Your comments are due this Friday, August 5th. And we've convened this opportunity for you to hear directly from the bank regulatory agencies about this proposal, as we all consider ways in which it can be strengthened and enhanced. So I want to thank our panelists today. We have joining us Eric Belsky, Director of the Division of Consumer and Community Affairs at the Board of Governors of the Federal Reserve System. We have Grovetta Gardineer, Senior Deputy Comptroller for Bank Supervision Policy, Office of the Comptroller of the Currency. And we have Mark Pearce, Director of the Division of Depositor and Consumer Protection at the Federal Deposit Insurance Corporation. So the three agencies that have issued the joint rule. And moderating today's session will be NCRC Vice Chairperson and former Chair and founding board member of NCRC, Irv Henderson. And with that, I will turn it over to Irv to get us going. Irv?
Thank you, Jesse, so much. And thanks to all of my colleagues at NCRC, as well as the regulators, for joining us today. As Jesse said, this is an incredibly important event. It's an important part of our work, and it's a critical conversation for this point in time. We're so glad to have each of our colleagues here who will be able to speak to us from the regulatory environment and framework. And indeed, it is a great group of senior folk who do a great job for our communities and for the country. So Eric, Grovetta, Mark, I'd like to give each of you an opportunity to quickly introduce yourselves and tell us something you are hoping to see come out of this upcoming CRA reform. And why don't we begin with Eric? Eric, you're muted.
It's classic. Let me start by saying it's always a pleasure to be with you, Irv, and thanks so much to NCRC for the invitation to all three of us to be able to come and speak to you and give you some more details on how the agencies are thinking about this reform of CRA regulations. And I thought Jesse's opening remarks underscored the importance of this reform work, I think, quite well. And in terms of what I'm hoping the reform accomplishes, really all the objectives that are laid out in the proposal are important aims to us. And I would probably emphasize the first one, which is strengthening the core purposes of CRA. And that's to do things like promote financial inclusion and access to credit, investment in basic banking services in low and moderate income communities. So I think that's really a crucially important kind of North Star for the effort.
Grovetta?
So thank you, Irv. It is great to be here and have an opportunity to meet with NCRC's membership. Thanks to Jesse, glad that he's feeling better and has recovered from the conference. I would just say pretty much ditto to everything that Eric just said. I think that we do look at all of the objectives. Eric specifically mentioned strengthening the CRA framework so that it meets the goals of the statute. I'll go for the opposite end of that bookend and say I'm really looking for it to modernize and reflect how financial institutions are delivering their products and services, deploying that capital into low and moderate income communities in order to help low and moderate income individuals. This, I think, is that modernization piece. We are a long way from where we were in 1977 and what banking looked like at that time and how consumers actually engaged in doing and transacting their financial business. And we want to make sure that the noble goals that are outlined in the CRA statute live on forever. And so the modernization aspect to me is incredibly important because it really encapsulates the longevity that I hope CRA will always have. The responsibility it imposes on financial institutions to really give back to those communities where it is doing business. And I think we'll talk about that a little bit more, but just where they're doing business is an aspect of the modernization that we really need to address during this important time.
Thank you so much. Mark?
Yeah, Eric and Grovetta have really covered it, and the core of it is expanding access to credit, lending, and basic banking services for LMI consumers, communities of color. I mean, that's why we're doing this work, and to do it, as Grovetta said, we have to modernize CRA and adapt to changes in the banking industry. And along the way, we want to make it clearer, more certain, and so that we can actually get the activity that we think is adds value to the LMI communities, and do it in a way that really reflects the differences among the different kinds of banks that serve the communities, small, medium, large, et cetera. And so, it's a big lift, and I really think of this as as Grovetta said, it's been over 25 years since we've taken a significant effort at modernizing the CRA regulations, and we want to do something that will be beneficial and last and stand the test of time.
Well, I think those are great introductions by each of you, and I'm going to hang on the term noble goals that Grovetta gave us as our theme for today. So why don't we launch right in using every minute of time we can. So as regulators, how will you consider bank partnerships with non-banks, particularly those in which the bank partners with the non-bank for purposes of evading state usury limits on consumer loans?
So maybe I'll start with that one. You mentioned Irvin at the outset, bank regulators. We are bank regulators, and we regulate the banks. And from the FDIC's perspective, and I'm certain Eric and Grovetta will agree with me on this, is that we treat activity by a bank, whether they do it directly or do it through third parties, the same. We hold them to the same standards. We want them to meet all the federal consumer protection requirements and other requirements to operate in a safe and sound manner. And we hold them equally accountable regardless of how they offer their loan products. I think, and how that translates into CRA is under the existing regulations of CRA, evidence of discriminatory or other illegal credit practices can affect the bank's rating and can lead to downgrades. And if we identify violations of law, One thing that we have in this proposal that I want to call to attention is that we are expanding the scope of activities that will be considered in that to include any discriminatory activity, not just in the lending market, but it could also happen in customer service and deposits and other places. And so we've expanded the scope of activities that we can, if we identify violations of law, we can downgrade the bank's rating, if the situation warrants.
Well, thank you for that. Next, how will CRA reform take into account the quality of lending and make sure loans are both sustainable and not abusive?
I'll start on that one, and I'll echo some of the things that Mark just mentioned. I think it's really an important question that you just asked, so I really appreciate the opportunity to address it. So I think several safeguards are built into the proposal. They mostly divide into two sets of elements. One is the treatment of discrimination when we find it, which Mark was just referencing, and the other is the consideration of, and availability and responsiveness of lending and other products. So let me take a moment and talk about each one. It's really not just about volumes and shares of low and moderate income lending and small business and small farm activity, although it's very importantly about that. It's also about whether products and services are offered fairly and they're responsive. So on the first one, on the treatment of discrimination and other illegal credit practices, the proposal just basically doubles down on what we've done before, which is ensuring CRA and fair lending are mutually reinforcing. So fair lending violations, as Mark said, can still result in a downgrade of a CRA rating or downgrades of CRA ratings, and updates also the criteria for deciding when to do so. It continues to treat assessment areas that exclude minority communities as impermissible. And in addition, it makes clear that assessment areas can't arbitrarily exclude low and consensus checks. We also expect at a minimum that county level geographic areas for large bank assessment areas will help with that. But then there's the other, which is one that Mark also mentioned, which is that what we propose goes beyond discrimination in lending by proposing for the first time that an examiner could downgrade a rating for any discriminatory practice with respect to consumer financial products and services, and that includes deposit products or other products and services offered by the bank. The agencies also propose that such practices, if they're found in a bank's operating subsidiaries or affiliate whose retail lending is evaluated at the bank's option, could also result in downgrade to the bank's CRA rating. And then second is the proposed focus on availability and on availability and the responsiveness of retail products and services to low and moderate income customers, small businesses, and small farms. So let me offer the example of the qualitative assessment of unsecured lines of credit and credit card consumer lending for large banks. That review would include things like rates of successful repayment, terms including underwriting and pricing like interest rates, and any other safeguards in place to minimize risk of adverse borrower outcomes. Similarly, the proposal would assess the availability and responsiveness of deposit products and services as well for banks with over 10 billion in assets in a way that very much focuses on the quality, usefulness, and adoption of responsive deposit products and services. So these are some of the ways that the proposal would take into account the quality of lending and other consumer financial products and services.
Yeah, so the comprehensive nature of what you've described is something that I think bears a lot of study, and I appreciate your unpacking it in the way that you did.
Thank you.
Next question. How about extending proposed data reporting regarding better deposit data and automobile lending to all large banks, not just those with assets of more than $10 billion? And how about making this data available in a public database?
Yeah, Irv, I'll jump in on that one, and I'll sort of pivot back to something Grovetta talked about in her opening, is that it's not 1995, right? We've over the time we've gotten a lot more data that's available. We want to make sure we leverage that in the course of the CRA evaluation to the maximum extent possible. And I think one of the trade-offs that we wrestled with a whole bunch during the course of our discussions was, how do we use the data in the best possible way to help us inform the evaluation, right? You know, what's the data we need to be able to accomplish our goals that we talked about earlier, and do it in a way that then is, you know, consistent and commensurate with the resources and the ability of the bank to provide that information. And so that's really the balancing that we arm wrestled as we went through lots of this to try to find that right spot to get the data we need to do the evaluation, and also just the understanding of the challenges that it is in creating that data and providing it. And so maybe, you know, you mentioned auto lending as one of those areas, and for banks over $10 billion, we are requiring the collection of that data and reporting of that data by large banks, by those large banks over 10 billion. And I think, you know, to sort of give you an insight into how we thought about that is, you know, in the auto market, most of the automobile lending is actually made by non-banks. And so within, at least I think I've got this data right, that, you know, it's a portion of the market that is originated by banks. Now, if you look within that portion originated by banks, most of that activity, something like 90% of it, occurs in the banks that are over $10 billion in assets. And so that really seemed to be the place where that auto lending data would both be available and very important to help us evaluate a bank's lending in that activity, whereas the rest of it's kind of scattered among other banks, the other 5,000 banks out there. And so, you know, that's sort of the kind of balancing test that we thought about as we were going through the data, and not just in auto data, but deposit data is another area where we looked at that. And there are other places as well, and tried to really reach the right balance.
Yeah, it seems that the word balance is going to be something that is a touchstone for this conversation.
Yeah, and if I could just add on, I mean, you know, the other thing, Jesse mentioned this at the outset, but the comment period is still open, and we have, you know, August 5th coming up for the comment deadline. And this is one area where I really think getting public input would be valuable to help us, you know, assess whether we got the right balance. And I don't remember the number of the question that asked the details on this one, but I think understanding sort of the value of the data from your members' perspectives and from others, I think would be really valuable for us.
Well, thank you for that. So will you consider examining race in a more explicit manner than you proposed?
So I'll start with this one, Irvin, and my colleague Aaron and Mark may want to add more to this. Let me kind of set the stage on this. You know, in the preamble of our proposal, we certainly recognize that the CRA was one of several laws enacted in the 60s and 70s to address fairness and financial inclusion and access to housing and credit, including the Fair Housing Act and ECOA, Equal Credit Opportunity Act. And the preamble goes into, I'd say, a pretty good discussion about the history of redlining prior to passage of those laws. And in that preamble, we also acknowledge that even with the implementation of the CRA and other complementary laws, the wealth gap and disparities and other financial outcomes continues to exist and persist in terms of race and ethnicity. So Irv, I think, you know, you hit the nail on the head here. Balance is this theme that we have, because what we have, when you look at these facts, we have to balance that against the fact that the CRA statute itself doesn't include race-based standards or metrics. And so in our proposal, we're looking for ways that we can address race. And one of the things that we focused on is our objective to promote transparency And in doing so, we propose providing additional information to the public in CRA performance evaluations for large banks related to the distribution of home mortgage loans and applications by borrower race and ethnicity in each of the bank's assessment areas. Now, this requirement wouldn't independently impact the bank's CRA conclusions or ratings, but it does increase the availability of information through public disclosure. And some might actually say, you know, the HMDA data is already available, but it's not available sitting in context to what the assessment area of a financial institution looks like. So again, these are ways that we are really trying to provide that level of transparency through the proposal, but now you're going to hear a familiar song, I think, as we answer every question, which is, this is another area where comments are going to be incredibly important. Our lawyers, our policy folks really looked into this. We put a proposal on the table that we think will enhance that level of objective transparency, but we're certainly open to hearing what others say as we balance what the statute allows us to do and how we can meet those challenges by addressing race in the proposal.
So I thank both you and Mark for encouraging people to come forth with their comments by the 5th. That's the 5th of August. And you've both done a great job in mentioning that. So we appreciate that. And as Grovetta said, perhaps Mark and Eric would want to opine on this question as well.
I'll just jump in very quickly. I agree with everything Grovetta said. Obviously, the three agencies work carefully together on this, and would underscore what we talked about a little earlier, which is the important connection to the fair lending laws that were enacted in and around the same time, and that there's really no place for illegal discrimination in the marketplace, and that will be reflected in CRA assessments and evaluations. So I think that, you know, remains a cornerstone and very fundamentally important. And like the others, and as you said, I really would underscore and reiterate the importance of submitting comments on this subject by the end of the week for the agencies to consider as we move towards a final rule. We all understand sort of the history here, and it's just very helpful to get you know, specific comments and feedback.
Mark.
So, you know, I'll pick up where Eric ended, which is the history piece, which I think we're all very cognizant of the origins of the Community Reinvestment Act and the purposes of addressing redlining and the disinvestment in communities. And so I think that's something that we've been focused on and trying to think about ways that we can do that effectively has been really a goal. And, you know, I think we asked a question related to special purpose credit programs, which is maybe another tool under the Equal Credit Opportunity Act that institutions have looked at as to ways to address some of the challenges for communities of color. And so, you know, looking at that connection in particular as it relates to CRA is something that folks may want to take a look at and provide us with some feedback on.
Well, thank you so much. Our next question. How will CRA reform make the rating systems more meaningful and better able to depict differences in bank performance?
Sure, I'll jump in on this one. And again, thanks for the question. And I would say in a lot of ways, so let me try to just tick through it relatively quickly. It really is a central aspect of what we're trying to achieve with this package. And we're doing so in a way that invites public comment on this before we move to final rule, and in a way where more information is available to the public after the final rule is released to understand how conclusions around CRA ratings were reached. So let me start with the proposal to separately evaluate retail lending from retail services and products, from community development financing, and from community development services. All of this supports rigorous and tailored assessments for each of these areas and transparency about a bank's performance in each of these areas. So we think that the fundamental test design for large banks is really of critical importance to doing this. Let me turn now, I guess, to the proposal to set transparent public benchmarks for community development financing and performance benchmarks and performance ranges for retail lending. So we proposed retail lending performance ranges that facilitate specific public feedback because we proposed a particular framework for doing that. The proposal would also allow the public to see how banks compare to market and community benchmarks in each of their assessment areas, as well as to see how their performance in one county or MSA compares to another. The proposal also retains 5 performance conclusion categories at the assessment area level around the individual components, and that includes a low and a high satisfactory rating. And the proposal would also show the bank's performance scores across relevant performance tests, geographies, and at the institution level where those performance scores actually fall. So it's a lot of clarity, a lot of transparency. And then there's a whole bunch of other elements of the proposal that would allow for more meaningful assessment, I think, of performance and allow for better information on differences in bank performance to be included as part of the evaluation. So I'll just tick off a few. As already noted, the agencies propose to provide additional information to the public in CRA performance evaluations for large banks related to the distribution by borrower race and ethnicity of the bank's home mortgage loan applications and origination in each of the bank's assessment areas, as Grovetta said, and that's information that the agencies will provide and the public can see clearly. The proposal also concludes a specific set of 10 factors that reward banks for more impactful community development, financing, and service activities, and we expect public comment on these factors will be illuminating, and having a set of factors in the final rule will facilitate meaningful assessment of things that have impact in that area. The agencies, in addition, propose to separately assess low-income lending and lending to firms with gross annual revenues of $250,000 or less, not just to assess lending to firms with $1 million or less in revenues as now, or for low and moderate income more generally, because such sort of lending are considered as especially impactful and responsive. Another one that I think I may have mentioned is the review of the responsiveness of the availability of consumer credit products. And I guess maybe a final one I'll mention is that the review of banks with over 10 billion in assets will also include an evaluation of the availability and responsiveness of their depositor products, such as low-cost accounts. And all of this is just a lot, I think, of additional information that really does both make the rating system more meaningful and allows the public to see how different financial institutions and different places compare to specific kinds of benchmarks.
Well, thank you. Once again, that's a very fulsome answer with a lot of unpacking. And there's a lot of interest in geography as it speaks to this entire system. So talk a little bit more, if you would, about the benefits of assessment area reform. I think you certainly were beginning there, but can you give us a little bit more on assessment area reform?
So maybe I'll give one of my other colleagues a chance, but if not, I'll jump in. Anyone else want to start on that one?
Yeah, so Eric, I'll go ahead and pick up, give you a chance to take a deep breath and a drink of water. Because there's a lot in the answer that Eric provided about making the rating system more meaningful that I think is really important. And I should mention that there are some fact sheets and infographics that we put together to sort of be able to explain that. And so maybe we can get web links for some of that and send around, because I think it's really important to see how we're using data and information to make the ratings more objective, which has been a real key goal by stakeholders across the spectrum. When it comes to assessment area reform, that really is a critical and key element of the proposal to really do both the strengthening and the modernization pieces that we talked about at the outset. As folks here on this call are familiar with the CRA regulation, it has historically been bricks and mortar based. It's sort of where are the branches, and all of your activity is based on an assessment of the activity around those branches. And obviously over the last 27 years, we've seen a lot of evolution where we now have banks that are entirely online and digital and mobile phone and all of that. And so how do we incorporate that activity and be able to capture it and evaluate it and do it consistently so that banks of different business models are evaluated fairly and accurately? And so what we've come up with in the proposal, first of all, it retains the facility-based, branch-based assessment areas for large banks that we traditionally have had. Branches are still very important. They're especially important in low and moderate income communities and communities of color. The FDIC does research every couple of years with US Census on unbanked and underbanked households. And we have a lot rich data on how often people are using banks and how that particularly relates to folks with less education, both younger and older, so rural areas. So we can go through all of that, but that's a different webinar. But we retain that evaluation in the branch-based areas. In addition to that, we're adding retail lending assessment areas where there are concentrations of either home mortgage loans or small business loans. So banks that are doing activity in certain geographies of a certain amount, and it's 100 home loans and 250 small business loans, they will be assessed in that geography for that loan product. And that is really a key element that expands the coverage of CRA for that activity that's not tied to the branches. And that also helps us with banks that really don't have branches at all, right? So who are lending in different geographies dispersed around the country where they have a certain intensity of lending activities that will be evaluated. And then the third area is sort of the outside, sort of what else, outside retail lending assessment area that really then gives us the ability to look across for those institutions that really do have a dispersed portfolio that's not attached to a branch. We can evaluate the lending at that way, at that level as well. So regardless of your business model, there's a portion of the evaluation that will ensure that the activity that you're doing is considered and evaluated. And that will help us in places like, looking at credit deserts in particular, and making sure that the evaluation is fair and equitable regardless of the business model. And I'm sure I've got folks that may want to add on to that one because there's a lot to talk about in the assessment area space.
Maybe I'll add a couple of things. I think, one thing that's important, we think, is that for banks with more than 10 assessment areas, the proposal proposes to establish a 60% or more of the assessment areas must have a rating of at least below satisfactory to get a rating of satisfactory overall after weighting and rolling up all the tests at the different geographic levels. So we think that's important. And I think Mark, talked about CRA, quote unquote, deserts, those places where we see less, in particular, community development financing activity. And so the proposal also, under the impact factors, proposes to have certain geographic areas considered for places that would receive consideration for being especially impactful, like persistent poverty areas and native land areas, some of these things to address CRA deserts. And then because the retail assessment areas will be still very facility based, and there'll be assessments of community development financing in those assessment areas, we think that we retain a focus, and it's important to retain a focus on where banks have branches, but also banks can get consideration for CD financing, anywhere in the country. And then, as I said, with this specific, proposal that to the extent that activity takes place in persistent poverty areas or native land areas, they'd be considered especially impactful.
Well, that is certainly a reason to do more community development finance. And, that's a good thing. So why are the reforms to the service test and more emphasis on deposit products important? There's been a lot of discussion about the area of the proposed rule in the areas of deposits. So why service test and deposit data is so important?
So I'll jump in on this one, Irv. So the proposal seeks to draw on the existing approach to evaluate a bank's retail services while also updating and standardizing the evaluation criteria and reflecting, really, as Mark said, the now widespread use of mobile and online banking. And the retail services and products test would be, as proposed, more comprehensive to recognize that banks deliver services beyond branch and remote service facilities. So specifically, the availability and responsiveness of a bank's digital delivery systems, like their mobile and online banking services, and other delivery systems, such as telephone banking, bank by mail, bank at work programs. Those are including, to low and moderate income individuals and would be required for large banks with assets of over 10 billion. It's optional for other large banks that may have less capacity to meet new data collection requirements, but it would be required for those large banks. The second part of the retail services and products test would focus on the availability of responsive credit and deposit products that capture a bank's commitment to serving low and moderate income individuals, small businesses, and small farms. The evaluation of those deposit products would be required again for banks with assets over 10 billion and optional for the other ones, for the other large banks. So really, when you think about it, the ability to conduct transactions and access funds in a timely manner is really highly relevant for lower income individuals or unbanked and underserved individuals who might otherwise acquire financial services at a higher cost from non-bank sources. And while heretofore we've been very focused under the CRA with regard to the delivery of credit products, we certainly, I think, across our agencies and our supervisory experience, have really seen the evolution and the impact of those deposit products and how they can be offered. And if they're offered on a, in a way that is responsive and provides a positive impact to those individuals, or, is it a contrary approach where there's a deposit product and it is not offered on a fair basis? It seizes upon, let's say, some of the hardships that lower moderate income individuals can find themselves in. And so if a deposit product is, creating that kind of inequity, contributing to a lack of fairness, not meeting the responsibility imposed by the CRA statute, we should be able to capture that. And we should be able to, assess and provide positive consideration when a bank is delivering a deposit product in a meaningful, impactful, and responsive way. And if not, we should be able to call that out in that public evaluation. So I think it's again, looking at the evolution of the financial industries market, the way these types of products have been offered, and being able to capture it now in that meaningful way as a part of the modernization effort and the strengthening that we hope to achieve through a final rule with the CRA. So again, I know I'm a broken record, Irv, but this again is another area where getting some good comments from stakeholders is going to be really important, because this is an addition for us, given what we've seen.
Well, we should probably just have a sign that we can hold up that says before August 5th, and then everybody will know what we're talking about. But the cost of these products is so important now in this period of time where inflation and everything else is causing many households to tighten their belt. So I appreciate your comments there. Will CRA reform increase home ownership and small business ownership and wealth building for low mod populations and people of color? will we see increases in these areas because of modernization and reform?
Maybe I'll jump in on this one, and I'd say, Irv, we expect so, because the proposal has a number of features that should help promote that outcome. First, it rewards banks for affordable housing financing and activities that support affordable housing. Obviously, this has been a long, time feature of CRA, but a crucial feature really, and being able to support affordable housing, I think, really makes a big difference in terms of people's ability to save for home ownership if you have a lower or moderate income. And it certainly has a disproportionately positive impact on people of color because of average incomes are lower for them. It separately assesses mortgage lending to low income, as I said earlier, and lending to the smallest businesses, which the proposal defines as firms with 250,000 or less in annual gross revenues. And this is really important to promoting asset building, both through home ownership and through equity in a business, both areas where, as Grovetta said at the top, we just continue to see these really troubling and very large disparities in outcomes. And we think that focus on low income, that focus on the smallest businesses, that's really important. It proposes also retail lending performance ranges that appropriately, I think, reward strong performance in reaching out to those markets as well. And as I mentioned, it places the actual performance of a bank on a scale, and it shows where a bank's performance falls relative to a set of locally tailored benchmarks intended to capture local credit needs, but also performance of peers. And one set, is tailored to the local community conditions, and the other set is tailored to local peer lending performance, and that's for home mortgages, small businesses, and other retail lending. Then, in addition, for community development activities, the agencies propose that examiners take into account, as I said, activities with greater impact, and this, this notion of creating impact factors, we think is very important. And it emphasizes again for impact, not just separate evaluation loans to low income borrowers and the smallest businesses. And in addition to that, other impact factors include loans and investments into minority depository institutions, community development financial institutions, low-income credit unions, women-owned depository institutions. All of these kinds of organizations really have track records of serving low and moderate income communities and people of color, as well as for working in persistent poverty areas and native land areas. And those are also in and of themselves persistent poverty and native land areas proposed impact factors. So we think all of this adds up to what we think will make a meaningful difference.
Well, asset building is certainly the strongest bulwark against persistent poverty. So I think that's very important for us to give our focus.
Yeah, and you go back all the way to the realization that assets for the poor really are incredibly vital and important. And so much of CRA is really oriented very specifically at that. It also is oriented towards creating those affordable housing opportunities, to creating the kind of economic development in communities that help with incomes and other things. All those things, we thought about very deeply and really tried to address in a meaningful and thoughtful way in this proposal. And we'll all jump on that bandwagon. We're at this moment where people still have an opportunity to provide us comment letters, and those comment letters are just so fundamentally important to helping us get it right. We really want to do our best to do that in a thoughtful and balanced way, and those comments are just critical to our ability to do that, and really a strength of the whole process of rulemaking in our country.
No, absolutely. So a couple questions, and we're not that far from having to end. So I'm going to ask each of you, if you want to add something after one of your colleagues has spoken, please feel free to do so. So how might new regulations encourage banks to support capacity building for nonprofit organizations, including through capacity-focused grant making, but also board service?
So I'll jump in on this one, Irv. So one thing that the proposed rule is going to do is, as drafted, grants and donations to Treasury certified CDFIs, for example, would be considered particularly impactful under the proposal. And both industry and community stakeholders have acknowledged the value of community development services and establishing partnerships needed to build capacity and foster the growth of the community development ecosystem. Now, separately assessing a bank's community development services and assigning a community development services test conclusion underscores in our proposal the importance of these activities for fostering partnerships among different stakeholders. And that, of course, then in turn builds capacity and creates the conditions for effective community development. And that, I think, is incredibly important in rural areas. Another thing that we really want to highlight and did highlight in the proposal. So there are a number of things that I think that we included in the proposal that are truly designed to help support that capacity building for nonprofits.
Well, thank you so much. Now, could you tell us a little bit about what happens after the comment period ends this Friday? Where do we go from here in terms of the process? And if each of you could opine, I would appreciate it.
All right. Well, I'll start because, you know, the most important thing, I don't have a sign yet, or if you didn't give me enough time to go make a sign that I could hold up that says comment period ends August the 5th. But
one of those streaming banners at the bottom of the like
that
in
is
the
what we
Peloton.
You know, 11:59 p.m. August 5th is when the comment period closes. And, you know, as we've done throughout this entire call and everywhere, I think that we have a chance to scream from the rooftops. If we didn't have the little blue crawler on the screen, we really do encourage all the stakeholders to comment on every aspect of the proposal. I think we asked 180 questions or so. When you haven't updated something since 1995 of this magnitude, given the significant number of changes in the delivery systems, in the financial system, in the way people access their finances, then we need every comment and everybody to take a look at this and provide us their feedback. But once we get the feedback, you know, I'll go a little bit and then I'll throw this potato to whoever wants to catch it. We're going to review all of these public comments. And, you know, we haven't taken odds yet on how many comments we think there will be. I think before the end of the week, I have to poll my colleagues here and see who's going to win the dollar bet on and get closest to the ultimate number of comments we're going to get. But what I can tell you, as we are reviewing all of the comments that we anticipate getting before midnight on the 5th of August, we really do, I think I can speak and say that our agencies have made the CRA rulemaking and its modernization and strengthening a priority. And it is a priority for our three agencies. And we're going to work as expeditiously, I would say, as possible to review all those comments, take all of that feedback, balance it against what we proposed in order to try to reconcile and get to a final rule. Soon. Is it always the regulatory soon as we can? Because I don't think there's a date certain that we can give you because we don't know how many comments we've gotten in yet. But that's a huge part of the process. And so with that, I'm going to throw it to Eric.
And obviously not just the number of comments. We expect to get very detailed comments, and we expect to get really thoughtful ideas and suggestions on the table, some of which we, may not have had. And we owe it to everyone to think about them and review them. So for that reason, I would agree with Grovetta. It's really hard to say, when, except what Grovetta said, that we're all very, very focused on this for obvious reasons. We think we've come very far. We have a long history of a public record around here that we were able to build on, and other advanced notice of proposed rulemakings and even rulemaking and reactions to that just really have created this incredibly rich ground. But nevertheless, when you get to this stage where all three agencies are working together, and we have like a small army of people, and I'd emphasize small but very very focused on doing a great job in reviewing those comments, and then also working to decide how to reflect and respond to them, standing by. But when you get to this stage, you do expect to get comments and suggestions we haven't seen before, because the level of detail and some of the specific elements that were in this particular proposal were quite different, and I think went further in a number of different areas and directions. So I think, for that reason, we're, committed to doing what we can with deliberate speed, but doing it well.
So detail is good, and detail is encouraged. And we want everyone to know that. You don't have a page limit. You can go ahead and send in a very detailed, comprehensive comment. Mark, your final comment.
Yeah, it's I'd say we want to get it right, and I think having detailed, focused comments, and as we've been over this panel, I mean, there almost any of these areas we could have talked the entire time about any one of the questions or that you asked us, and really gone into depth. And as Eric mentioned, we came up with this proposal based on not just the work we've been doing the last few months, but the last few years in thinking about how to modernize CRA, and so. We're really looking forward to getting the feedback, because I'm sure just in the time that we've had the open comment period, we've had conversations and feedback from people of raising different points that we hadn't thought about, or we thought about in different ways. And so it's just really valuable to get the feedback. And so we've got a lot of reading to do starting August 5th or August 6th. I think with all of that, I would just share the sense of urgency that we want to move a proposal forward after evaluating the comments and considering it, because it's really important that CRA, it is an opportunity to modernize it. The agencies have been working together closely, and we're committed to an interagency approach on CRA to stand the test of time. And so, we're all kind of focused and got at the top of our agendas to do.
Let me just, the closing thing is, we have the finest staff really across these agencies, really dedicated, really hardworking, broad range of knowledge and experiences, from those steeped in the examination world to those steeped into every aspect of community development and finance. So we really feel we're well positioned, and incredibly grateful for that. And I'll thank my two colleagues who are here on the call with me for their patience and graciousness over time.
Well, we want to echo that for all of the folk that work at the regulatory agencies, who are all public servants, and we appreciate their service greatly. Unfortunately, that's all the time we have today. I want to thank our guests for taking time to share their insights into this historic opportunity to update the Community Reinvestment Act to better serve all of our communities, and the work that they're doing to make sure those revisions take into account input from stakeholders like all of you who are here today. And thank you, NCRC members and allies, for joining us today. A special thank you to NCRC members who submitted questions for today's discussion in advance. Make sure you submit your comment by this Friday. And Katie, I believe you have a couple of next steps to share with folks, but thanks to our regulatory colleagues again. Katie?
Absolutely. And thank you, Irvin. Thank you, to our panelists. This was a fantastic conversation. I don't know if anybody else heard a particular date get floated around on this conversation, but if August 5th midnight is not already marked in red on your calendar, it should be. I think that is where all of our urgency is right now. And I do want to echo the thanks both to the regulators and the work that they're doing, but also to the NCRC community for really making sure that this is a really thorough revision process. So I'm excited to see that continue. There's a link in the chat to submit your feedback on today's event. We do take those very seriously. So, let us know how you thought this went and what you, hope to see in the future. For those of you who are working on your comments, ncrc.org/treasurerCRA is a great resource with sample comment letters, data, etc. Take a look at that. Look out for a follow-up email tomorrow that will contain a link to today's recording, as well as a link to that Treasurer CRA page. And for those of you who are NCRC members or thinking about joining NCRC, we have a membership benefits webinar coming up next Thursday. So check that out at ncrc.org/events to learn more about how NCRC can support you as you support your community. And if you're not a current NCRC member, join or renew online at ncrc.org/membership. Members get discounted tickets to the Just Economy Conference, access to data and custom research to help you leverage CRA, as well as updates and opportunities to engage in our policy and advocacy work, just like the work that we're all engaged in right now around CRA. So thank you again. Appreciate each and every one of you. Have a wonderful rest of the day.